Okay, picture this. It's payday, you've worked incredibly hard, you've put in the grueling hours, and you're expecting the full weight of that promised salary to finally hit your bank account. I mean, it's supposed to be the best day of the week, right? But instead, a massive chunk of your earnings has quietly vanished into thin air before you ever even saw it. One by one, this series of invisible deductions has relentlessly chipped away at the gross amount you were promised. Now, most people just glance at that final, much smaller number, let out a deep sigh, and move on. But today, we are going to look closer at exactly what is happening behind the scenes.
Let's start with what we call the paper illusion. Think about that very first time someone gets a real job offer. They see that impressive $100,000 salary written in bold on the offer letter, and they immediately start doing the mental math. They divide that massive number by 12, imagining the fancy new apartment or the amazing vacations they can finally afford. It looks absolutely great on paper, until tens of thousands of dollars quietly disappear before it ever reaches their hands. When your employer says you earn a certain amount, you have to realize that number exists mostly as a theoretical concept. The amount you actually receive is dramatically lower. Now, just to be clear, this isn't some wild conspiracy theory. Taxes fund our roads, emergency services, and national defense. But understanding exactly how, where, and why this money leaves your paycheck is literally one of the most powerful financial tools you can possess.
To truly wrap our heads around this, let's look at two professionals who might be totally bragging about the exact same salary, yet living a completely different financial reality simply based on geography and their benefit choices. Imagine two people who both proudly say they make $100 grand a year. One lives in Texas. Now, Texas doesn't have a broad state income tax on wages, and let's say this earner opted for a more basic, cheaper health plan. The other earner lives in California, where they're paying a significant state income tax, plus they've contributed to a top-tier, really expensive employer health insurance plan. By the time payday actually rolls around, their bank deposits are going to look staggeringly different. They have the exact same starting salary, but because of that geographical premium and personal choices, they are living in a completely different financial reality.
Which brings us to the million-dollar question. Where does all that money actually go? Have you ever just stared at line 4 of your pay stub and thought, wait, who exactly authorized that deduction? Because understanding how and why this money leaves your paycheck is an absolutely crucial financial lesson that nobody is taught in school. Your paycheck isn't just a simple payment for services rendered. It is the final result of dozens of rapid-fire financial calculations happening completely behind the scenes in milliseconds. And if you don't know what those calculations are doing, you're effectively navigating your entire financial life blindfolded, just hoping you end up somewhere safe.
In literally a matter of seconds, automated software comes in and carves up your hard work into 4 totally distinct slices. The first slice goes straight to federal and state income taxes. Boom, gone. Another hefty slice is directed to Social Security and Medicare. Yet another piece gets pulled out to cover employer benefits, things like health insurance or your retirement contributions. And finally, what is left over in that last slice is your actual take-home pay. The entire pie is carved up and distributed way before the deposit even hits your checking account.
Now, historically, it wasn't always this seamless. Years ago, income taxes weren't automatically stripped right out of your pay. You got your money, and you had to physically pay the government later. But governments quickly realized a pretty fundamental truth about us. Human beings are terrible at saving up for massive annual tax bills. Collecting taxes directly from employers was far more efficient than chasing down millions of individual payments from citizens who had, well, already spent the money. So they changed the rules to intercept the money automatically. It's a brilliant, friction-free system for tax collection for sure, but it completely changed our financial psychology. It's the exact reason why so many people today vastly underestimate how much they actually earn and how much they pay into the system.
And this brings us to a massive misunderstanding: the progressive tax system. You would not believe how many people refuse to work overtime because they think getting pushed into a higher tax bracket means all of their income is suddenly taxed at a higher rate. Let's clear this up right now with a simple analogy. Think of tax brackets like buckets of water. Your first dollars fill up the 10% bucket. Once that bucket is totally full, any overflow starts filling the 12% bucket, and so on. The higher tax rate only applies to the overflow water, never the water sitting in the earlier buckets. People often work overtime, see a slightly smaller bump than they expected due to payroll estimation formulas, and immediately assume the government just took all their extra money. Understanding these buckets prevents the false, damaging belief that working harder isn't worth your time.
So, here is the exact lineup of the usual suspects quietly reducing your gross pay. First up are the standard federal taxes, paying for everything from national defense to federal highways. Then, we have the social safety nets. Social Security takes a cut, which essentially means today's active workforce is directly funding today's current beneficiaries. Medicare operates similarly, helping fund health coverage for those 65 and older. From there, state and local taxes take their share, and that depends entirely on where you choose to live and work. Finally, you have employer benefits like health, dental, and vision premiums. These aren't just random letters and numbers on a stub, they are specific, legally mandated destinations for your cash.
But wait, here's a major plot twist. Not all deductions are expenses. Some deductions, like a 401k match, are actually incredible investments in your future. They represent the closest thing to free money in all of personal finance. When you contribute to a traditional retirement account, that money isn't lost. It's simply moving from today's spending bucket into tomorrow's financial security bucket. And if your employer offers a match, they are literally handing you extra compensation. Billions of dollars in employer matches are left on the table every single year, simply because workers don't understand it or they refuse to accept a slightly smaller take-home pay today. Seriously, if you haven't checked your benefits lately, you need to do it tomorrow morning.
Okay, grasping how different types of income are treated by the system is honestly one of the most profound mindset shifts you can make for building wealth. Let's really look at this contrast. A salaried employee has their taxes withheld before they ever receive a dime. They get paid on whatever is left over. But a business owner, they operate on a completely inverted formula. They generally calculate their taxable profit after accounting for eligible business expenses under the tax laws. They earn, they spend on the business, and they get taxed on what is left over. Now, it certainly doesn't mean businesses don't pay taxes, but it means the system operates on an entirely different set of rules, depending on exactly how you structure your income.
Let's get crystal clear on two terms that get thrown around a lot, because the wealthy spend years legally planning to keep their money using government-designed incentives. To put it super simply, tax avoidance is a highly strategic, completely legal conversation you have with your accountant. Tax evasion? That is a very bad, highly illegal conversation you have with your defense attorney. Evasion is a crime. It's illegally hiding income. Avoidance means utilizing the specific deductions, credits, and incentives that lawmakers intentionally created to encourage specific behaviors, like investing in a business or buying real estate. Wealthy individuals don't just earn higher incomes, they intimately understand these rules.
And knowing the specific mechanical difference between a tax deduction and a tax credit is absolutely vital. Let's do some rapid-fire math to show exactly why. A tax deduction reduces your taxable income. So if you're in the 20% tax bracket, a $1,000 deduction saves you $200 on your tax bill. But a tax credit? That reduces the actual tax you owe, dollar for dollar. A $1,000 tax credit saves you exactly $1,000. Credits are literally the ultimate golden ticket in the tax code. People who become financially successful understand these mechanics deeply, and they use that knowledge to make vastly smarter choices year after year. Now, I know a lot of people celebrate a massive tax refund every spring like they just hit the jackpot. But in reality, it usually just means you gave the government a massive, interest-free loan of your own money for an entire 12 months. When you get a $5,000 refund, it usually means your payroll deductions were just set way too high. It was your money all along, locked in a government vault. Think about the opportunity cost here. Instead of losing value to inflation, that $5,000 could have been sitting in a high-yield savings account or an index fund, actually compounding and making you money all year long.
This perfectly sets up the psychological reason why millions of people stay stuck financially, even as their careers advance. Income creates opportunities, but your habits determine your outcomes. Think about that deeply familiar feeling of getting a raise, making more money than you ever have before, but still feeling entirely broke at the end of the month. You can have the largest paycheck in the world, but if you don't understand how to keep it and grow it, you will constantly feel stressed. The paycheck itself was never the problem. The real problem is working your whole life for money without ever learning how money actually works.
Now, what's really fascinating here is that this exposes the ultimate killer of wealth building, lifestyle inflation. This is where a $10,000 raise just immediately vanishes into an upgraded life. You get a promotion. Your paycheck legitimately goes up. But instead of capturing that difference and investing it, you upgrade your reality to match it. The reliable Honda turns into a leased BMW. Weekly takeout turns into fine dining. The modest apartment turns into a luxury high-rise. The higher salary just becomes your new baseline normal. Your income goes up, your expenses match it perfectly stride for stride, and your actual net wealth stays completely, tragically flat.
Because of this, appearances can be incredibly misleading. You know the type. The flashy spender looks incredibly rich on social media, earning $250,000 a year, but they are trapped in a vicious cycle of high-interest debt and paycheck-to-paycheck panic just to keep up the facade. Meanwhile, the quiet builder is earning $75,000, but they actually understand the mechanics of money. They capture their employer match, they avoid bad debt, and they invest consistently. They aren't buying depreciating metal and plastic to impress strangers, they are buying their own freedom. Through the sheer, unstoppable power of compounding, the quiet builder will often end up with vastly more actual wealth than the high earner. Financial freedom rarely looks flashy in the beginning.
Once you truly grasp how taxes, benefits, and compounding actually operate, you totally stop seeing your paycheck as the finish line. Instead, you start viewing every single dollar as an employee. Every time you get paid, you are hiring an army of green soldiers whose only job is to go out into the market and capture more money for you. Every deduction on your stub tells you a story about where your money is flowing. Every benefit gives you a chance to make a strategic choice. Building enduring wealth isn't about scoring one massive, lucky paycheck. It's about thousands of smart, small decisions that you relentlessly repeat over an entire lifetime.
We all work way too hard to let our earnings just slip through our fingers simply because we didn't know the rules of the game. You now have the blueprint to decode exactly where your money goes and how to make it work harder for you. Keep learning, keep questioning every single deduction, and keep optimizing your financial life. So, if this explainer changed how you view your money, share it with someone who works hard. And ask yourself this final, critical question before your next payday. Your next paycheck is coming? Whose future is it going to fund?